So I have a question for Keki in particular, but also relevant, and I would like to hear the answers from both Vaidya and Manish as well. And very specific question. Obviously, in financial sector, like in other sectors, over time we've had ownership restrictions, like in insurance, starting with 24, then 49, and so on and so forth. In banks also, there has been a 74% restriction. I would like to hear from you what have been the benefits of that, and are we at a time that we should reevaluate that restriction?
In my personal opinion, honestly, I mean it, I think we should relook at it, because in any case there are governance norms. RBI has laid down limits that no individual shareholder can own more than 5% or in certain cases 10% of the equity of a bank. So there are checks and balances which are already there in place. But if you just change that 74 to 100, the amount of additional money that can come into India.
100+ billion.
Exactly. So huge amount of money can come in, not necessarily directly in equity, but through these passive funds. Because the weightage in the MSCI would increase significantly.
And I might just add there, much larger would be the inflow from active funds as the weights in the indices go up.
Yeah. Active, yes, but I'm saying even active apart, passive also.
Anybody else wants to chime in on that?
Nothing, since insisting on my comment. See, when we talk of India's $35 trillion economy in 2047, right? Imagine even if the same credit to GDP ratio at that point of time, India will need a credit so-called book of at least, say, let me say, $25 trillion. And for that, you will probably need equity of maybe about $2.5 to $3 trillion. So we should therefore make a policy in such a way that attract that kind of capital. And I do not think all that capital can come from India through domestic sources alone. And therefore, we should always be conscious that of our capital requirements, and without capital, you will get strangled. And this is something you should be aware of. Our policy should gear to be able to originate foreign capital additionally to be able to meet that demand of credit for the country and take a GDP there. Otherwise, your GDP will actually not get there because you won't have the fuel to get there.
The only thing I'd add, Prashant, is there were regulations at a certain time for certain reasons. I would say two things have changed since then. The Indian let's take insurance. It's been 20 years. We have, they needed actuarial data from other places. We have that now. And I think the companies are strong enough to stand their own. And I would go with Keki that absolutely all restrictions should be relooked at, not for the point of attracting foreign capital. Both foreign and domestic capital will come. My only point, and it's a larger point which I like just stating out there, is from a regulatory perspective, sometimes the rules today are made to catch the bad apples, right? Often what's going on with the rules is the baby gets thrown out with the bathwater, right? So one should just be careful as we're open. We should open up, but also as we construct new rules to prevent bad behavior, it doesn't become as restrictive so that the green apples don't become bright, rosy red apples, and they fell at the bad ones.